The House of Representatives has narrowly passed a significant new tax bill with a vote of 215 to 214. This legislation introduces sweeping changes for both small business owners and individual taxpayers, with several amendments made at the last minute. The bill now heads to the Senate, where further negotiations and changes are expected before it can be signed into law by the President, potentially by July 4th. Key provisions for small business owners. Qualified business income, QBI deduction. The QBI deduction, previously set to expire, is made permanent and increased from 20% to 23%. For example, a business owner earning $200,000 would now get a $46,000 deduction permanently enshrined in the tax code. Bonus depreciation. The bill reinstates 100% bonus depreciation for equipment and qualifying vehicle purchases. This means business owners can deduct the full cost of such investments in the year they are made, rather than spreading the deduction over several years. This provision is set to expire in 2029 unless renewed. Notably, the deduction can be claimed even if the equipment is financed, not just paid for in cash. Major changes for individual taxpayers. Lower tax rates. Across all income brackets, tax rates are reduced by 2 to 3%. Without this bill, tax rates would revert to higher levels next year, e.g. the 22% bracket would rise to 25%, the 37% bracket to 39%. The bill makes these lower rates permanent, avoiding another expiration cliff that would require future congressional action. Doubling the standard deduction. The standard deduction for married couples, set to rise to $16,600 in 2026, will instead double to $34,000 under the new bill. This change primarily benefits middle-income Americans and could save a married couple earning $200,000 an estimated $3,000 in taxes, not counting additional savings from lower rates. Child tax credit. The child tax credit, which was set to fall to $1,000 per child, will be restored to $2,000 permanently, with an additional $500 per child for tax years 2025 through 2028. This is a direct credit against taxes owed, making it highly valuable for families. State and local tax SALT deduction cap. The cap on state and local tax deductions, a contentious issue especially in high-tax states, is raised from $10,000 to $40,000. The phase-out threshold for this deduction is increased to $500,000 in adjusted gross income, making it accessible to more taxpayers in high-tax states. New provisions on tips and overtime. No tax on tips. For the next 4 years, 2025 through 2028, tipped income will not be taxed for individuals earning less than $160,000 per year, provided the tips are voluntary and the occupation traditionally receives tips, e.g. bartenders, servers, barbers. The IRS will issue further guidance on qualifying professions. No tax on overtime. Similarly, overtime pay will not be taxed for individuals earning under $160,000 per year for tax years 2025 through 2028. The deduction applies to overtime paid in excess of regular hours. There are still questions regarding the practical implementation for both employees and independent contractors, with further IRS guidance expected. Political context and next steps. The bill passed along strict party lines, with Republicans in support and Democrats opposed. The narrow margin and contentious debates, especially around the SALT deduction, highlight the political challenges ahead as the bill moves to the Senate. The Senate, with similarly tight margins, is expected to introduce further changes before any final version is sent to the President, potentially by July 4th. Conclusion. This tax bill represents one of the most significant overhauls in recent years, offering substantial permanent benefits for small business owners and meaningful relief for individuals, especially those with children or living in high-tax states. However, some provisions, such as bonus depreciation and tax relief on tips and overtime, are temporary and set to expire unless renewed. The fate of the bill now rests with the Senate, where further negotiations could alter its final form.